Good afternoon, everyone. This is the meeting of the Police and Firefighter Pension Board of Trustees. I'm going to turn it over to Chris Canning to call the meeting to order and then to read an opening statement.
Well, good afternoon, everyone, and thank you very much for joining us. This is a joint meeting of the Police and Fire Pension Boards of the Village of Wilmette. First item on the agenda after the call to order is a roll call. On the fire side, Jason, can you call roll?
Mr. Canning?
Here.
Ms. Malloy?
Here.
Mr. Mitchell?
Here.
Mr. Weglars? Here. Absent is Mr. Grajewski.
So the fire side has a quorum. I'll turn it over to the president of the police board, Dave Farina.
Hi, everybody. Pat, are you there? Can you do the roll call, please?
Yes. Mr. Farina?
Here.
Mr. Kinzel?
Here.
Mr. Collins here. Mr. Sokolnik?
Here.
Mr. Paulson?
I'm here. Okay, so the police has a quorum as well. As you see, we are conducting this meeting via Teams. It is also available on Channel 6. In keeping with the governor's order as well as the actions of the General Assembly, I will read the following statement into the record. This meeting is being conducted remotely via Microsoft Teams. For those watching this video in the future, effective June 12th, 2020, Public Act 101640 enacted the Government Emergency Administration Act, which makes permanent changes to the Illinois Open Meetings Act. Under new Section 7 sub E of the Open Meetings Act, public bodies may now conduct remote public meetings by audio or video conference without a quorum physically present when the governor or director of the Illinois Department of Public Health has issued a disaster declaration related to public health concerns. This meeting is being broadcast live on our local cable access channel 6. It is also being broadcast on the internet on YouTube Live, and the URL for that is www.youtube.com/user/Village of Wilmette, all run together, no spaces, /live. If you'd like to participate in the meeting, you may use the Microsoft Teams app on any device for free. No sign-in is required. The link to join each meeting is posted on the website calendar at www.wilmette.com/calendar. The meeting will be archived on the village's website as we do with our other televised public meetings. Now, a remote meeting obviously requires a different mechanic for public participation. So to ensure that our residents, business owners, and other interested parties have the opportunity to participate in this meeting, we have solicited public comment prior to the start of the meeting via email. If you send an email to public comments, all run together, at wilmette.com prior to the start of the meeting, our staff will read the email during the public comment portion of the agenda. If members of the public who are watching the broadcast would like to participate during our designated public comment periods, you may submit your comments through the YouTube Live at the appropriate time, and a member of the village staff will read your comments to the pension. All comments to the pension boards will be recorded in the meeting minutes as we typically do. Everyone will have joined the meeting today is muted. When it is time for public comment, those joining us with the Teams client can toggle their mute status by clicking on the microphone icon on the meeting toolbar, usually at the bottom of your screen. Those joining us by audio conference dial-in can toggle their mute status by pressing *6. Only attendees can unmute themselves. So board members, you can unmute yourself. No one can unmute another attendee. And just a reminder that public comment can also be provided by emailing public comment, all run together, at wilmette.com or through the village's YouTube live stream. Now, before the meeting, Pension Board Trustees received a packet of agenda materials. This quarter, our packet was 188 pages. All of the trustees have reviewed them. Those pages will be reviewing those matters today. The matters that we will be discussing are set out on the printed agenda, which is the first page of the packet. The packet is posted at wilmette.com so that anyone watching this, whether you're a resident, a business owner, or someone just interested, can go to wilmette.com, take a look at the packet, and see what we're discussing today or whenever you watch it. So thank you very much for attending today. Thank you very much for taking the time to watch this. And I'm going to move on to the next item on the agenda, which is the public comment. So I will start with Lynn. Has anyone made any public comments prior to the meeting?
Mr. Canning, no one has made any public comments prior to the meeting, and there are no comments on YouTube Live.
Okay. Is there anyone participating via telephonically or Microsoft Teams, member of the public who would like to comment on a matter which is not on the agenda? Comment on a matter which is not on the agenda. Okay, hearing no one, then we will move on to the next item on the agenda, which is the approval of the minutes. First item is the approval of the joint special meeting held on May 21st, 2020. On the fire side, may I have a motion to approve?
So moved.
Is there a second?
Second.
Okay, it's been moved and seconded. Any comments, corrections, clarifications, modifications, or amendments? Seeing none. Okay, one of the other items that has been changed by the recent law is that items such as this must have a roll call vote. Therefore, Mr. Weglars, could you please call the roll on the pending motion to approve the minutes?
Mr. Canning?
Aye.
Ms. Malloy?
Aye.
Mr. Mitchell?
Aye.
Mr. Weglars? Aye.
Okay, and so those minutes are approved. I'll now send it over to police.
Okay, I'd like a motion to approve the meeting minutes from the special meeting on May 21st, 2020.
Motion.
Can we get a second?
John, I'll second.
Okay, and then it might be easier if you say who it is when you say second and first, so Pat can get it all this. Probably know their voices, but anyhow, any comments, corrections, modifications, or on the minutes? Okay, hearing none, I'll turn it back to Pat to do the roll call vote.
Mr. Farina?
Yes.
Mr. Kinzel? Yeah.
Aye.
Mr. Collins? Aye. Mr. Sokolnik? Aye. Mr. Paulson?
Aye. Okay, so those minutes are approved. Next item on the agenda is pension trustee update related to the election of officers. Who's making that update?
So I think we should probably start with fire, Chris, and I think the first one that maybe we need to vote on is the secretary position.
Okay, is there a nomination for secretary?
I nominate Dave Grajewski.
Is there a second?
I second.
Are there any other nominations? Okay, hearing none, it's been moved and seconded. Roll call. Jason?
Mr. Canning?
Aye.
Ms. Malloy?
I say it with a smile.
Mr. Mitchell?
Aye.
And Mr. Weglars? Aye.
Record will reflect that one was more enthusiastic. Okay, next position we need?
We need president.
Okay, is there a nomination?
I would nominate Mr. Canning for president of the fire.
Is there a second?
I will second. Yep.
There you go.
Okay, it's been moved and seconded. Any other nominations? Okay, hearing none, roll call, please.
Mr. Canning?
Aye.
Ms. Malloy?
Aye.
Mr. Mitchell?
Aye.
Mr. Weglars? Aye.
Okay, so those officers' elections have taken place. Over to police.
I believe we have the same thing, so I guess we need a motion to nominate a president.
Motion, Kinzel? Giving the motion, obviously.
What's that?
You said to identify who's giving the motion. That's all I was doing.
Yeah. I guess we need a nominee,
Yeah.
which I guess is me, but.
Yes.
A second?
Nominating Dave Farina.
I'll second the motion to nominate Dave Farina as president.
Okay, so I guess we need a roll call to approve.
Roll call vote. Mr. Farina, abstain? Aye.
I can abstain, yeah, I'll abstain.
Mr. Kenzel?
Aye.
Mr. Collins, aye. Mr. Skolnick?
Aye.
Mr. Paulson?
Aye.
Okay, I'll make a motion to nominate Mr. Kinzel as vice president. Can we get a second?
I'll second, John.
Okay, roll call.
Mr. Farina?
Aye.
Mr. Kenzel?
Aye.
Mr. Collins, aye. Mr. Skolnick?
Aye.
Mr. Paulson?
All right.
Aye.
And I guess we need a motion to, I will make a motion to nominate Mr. Collins as secretary, if he wants to be the secretary.
I'll second.
I'll
John.
third it.
Roll call, please.
Mr. Farina?
Aye.
Mr. Kenzel?
Aye.
Mr. Collins, aye. Mr. Skolnick?
Aye.
Mr. Paulson?
Aye.
Okay, the motion carries. Do we need an assistant secretary?
I believe on ours we do.
We do? Okay, so who wants to be the assistant secretary?
Mr. Collins will nominate Mr. Skolnick as assistant secretary.
Okay, I will second that nomination. Roll call, please.
Roll call vote, Mr. Farina?
Aye.
Mr. Kenzel?
Aye.
Mr. Collins? Aye. Mr. Skolnick?
Aye.
Mr. Paulson?
Aye.
I think that's all we have to do, right, Pat?
I believe that concludes the election of officers. I just want to run through this next section quickly, which is pension membership changes, section 6 of the agenda. Correct me if I'm wrong, Melinda, but there's nothing for fire to do under this item. I think it's only police.
You are correct.
Okay, so I'm going to flip that over to Dave.
Okay, so we have to approve the initial increase for Daniel Walsh, page 9 of your packet. Melinda?
That is correct.
Okay, can we get a motion to approve the initial pension increase for Daniel Walsh as depicted on page 9 of the packet?
Motion?
Can we get a second?
John will second.
Okay, Pat, roll call, please. Mr. Collins?
Mr. Farina?
Aye.
Mr. Kenzel?
Aye.
Mr. Collins, aye. Mr. Skolnick?
Aye.
Mr. Paulson?
Aye.
And I guess we could do the same for Mr. I don't even know how to say his last name. Hemisad?
Yes. But before we go on to that, Dave, if you don't mind, there is just the recognition. You don't have to take a vote on this, just so that you know that there was a pensioner spouse who passed away, just so you know that there was a change in membership for that reason. And then when you're talking about Mr. Hemisath, that was on our agenda last time. What was missing was the backup documentation that proved out the actual initial increase. So I had promised at our last meeting that on this one, I would have it on the agenda again, and so you will see the calculation as well as the prove out with the Department of Insurance. So you really did take action on the last agenda to approve his increase. What you didn't see was all the backup information on this one. If you'd like to take a vote on it again, you can. There's nothing that's preventing you, but I just want to let you know why that's on a separate sheet.
We don't need to take a vote. I think we're satisfied. Everybody else okay?
Yes.
That's fine.
Okay. We're finished with pension increases. Back to you, Chris.
Okay, at this time, I would like to advance an item on the agenda. It is agenda item 8D, Manager Review, Jochum International Select Mutual Fund. symbol JOHIX, Tom McAvoy and Damon Goff, who I believe are in the waiting room. So if they are, would you please have them join us?
Yes, Tom.
Yep, they are part of the meeting.
Okay, Tom, Damon, welcome.
Thank you.
Thank you.
And as we're starting this, I was just sharing my screen, so hopefully everyone can see this right now.
Could I say something? This is Tom McShane.
Yes.
So I just want to, Jochum manages about $1.2 million for the police pension fund and the same amount for the fire pension fund, which he, on the international equity strategy, and it equates to about 2.5% of the portfolio. Thank you.
Well, thank you for joining us. We've had a chance to review the materials you provided to us, which were included in our packet. So Melinda is sharing the screen. Tom, why don't you take it from here?
Yeah, thank you. And thank you, everyone, for your time today and including us on the call. As stated, my name is Tom McAvoy. I'm accompanied with Damon Goff, and we're both with JOHCM Funds. I work with Tom McShane and his Grayson team based out of Chicago, and I cover the Midwest. I believe we have about 15 or 20 minutes to talk today. Is that correct?
Yes.
Thank you. Yeah. So today, I'll give you a brief background on who J.O. Hambro is, and then I'll hand it off to Damon, who will go over our International Select Fund and its process. For those of you who don't know J.O. Hambro, we are a London-based asset manager with over $33 billion in assets under management and have an expertise in international investing. When you look at our firm broadly, Hambro has 14 different teams located around the globe in offices in London, New York, Prague, and Singapore. Now, to tell you a little bit more about the JOHCM International Select Fund that you've invested in, I'll hand it over to Damon. Damon?
Thank you, Tom. Thank you, everyone, for making some time for us this afternoon. Before I get started, I just want to make sure that you guys are comfortable with the approach that we're going to take. We thought we'd just review quickly the investment team, the process, and of course, perhaps a bit of a recap on clearly the COVID period that we experienced this year and the subsequent bounce back, and a little bit around positioning. Does that make sense for everyone?
Yes.
Perfect. So I'm going to ask if we can jump all the way to page. We're going to start with page 32 in the presentation. Okay. So just a little bit of background, one additional thought around the team, the firm and the team. So this particular investment team, headed up by Chris Lees and Nudgem Mitchell, is actually based in our Singapore office. We also have an Asian equity team that sits in that office as well. Chris and Nudgem have been with us, with the firm, for over 10 years. And our entire business structure is based on hiring experienced PMs and basically bringing them over from outside organizations. They tend to be larger asset management groups like Fidelity. We have teams from First Eagle, from Goldman Sachs. And, we're really offering them a platform to work from. I think one of the interesting wrinkles about our organization relative to other investment managers is we don't have a CIO. We don't have a traditional, house view or investment process. So every team's a bit different in terms of their philosophy and process. We have teams that are very bottom-up oriented, teams that run very assertively top-down strategies, and then we have teams like Chris and Nudgem that actually combine elements of both top-down and bottom-up. So what you see on page 32 is some of the philosophical underpinning of the strategy itself. And I think, I'm just going to touch on a couple of these. I think what Chris and Nudgem bring to the table is understanding that you cannot necessarily apply uniform techniques and strategies to all parts of the world. I mean, a number of different regions can be highly variable in terms of how they trade, how share price moves. An example would be, in the emerging market space, many EM countries and share prices tend to correlate with the underlying country itself, as opposed to a lot of Western stocks where, individual companies tend to correlate or their share price moves in tandem with the industries that they sit in. I think, some of the other factors that we tend to focus on are things like correlations, as we just kind of described, and understanding that things like correlation beta and other relationships, that they're not stable over time, and that they are highly variable and can change quite quickly. And I think, what you've seen and experienced over the past couple of quarters is just further evidence that this type of volatility and speed of market moves is just going to become more and more pronounced over time. I think the team does a very good job of not, fearing or ignoring global themes and trends. I think they always embrace these ideas and think about them in a very expansive context, and then really, are good at distilling them down and what it means, really from an investment perspective, and how do we, populate the portfolio with ideas that are going to be able to, to leverage those themes and trends. A couple of the other things I think you've probably heard from many other managers, not confusing GDP growth with stock market returns. This is clearly not a strategy that's designed to mimic the index. You will see that we are very benchmark agnostic. It's a highly active approach to the international space that can have, a lot of, we like to say, kind of gaps in the portfolio, which you'll see in a couple of slides, kind of looks like Swiss cheese. So it doesn't, we're not trying to give you just pure beta exposure. I think the portfolio also tends to look very different than many of our other active international peers. If you jump to page 33, I'm going to just reference one of these points here, one or 2 points, into this idea of quantamental, which really is the thought about combining both quantitative investing and fundamental investing. Because I think what you see on a daily basis in markets is that, the average buyer of equities every day is a machine. It's an algorithm. It's a large, passive ETF company. The human intervention has become clearly less and less, but we do think that it is still very relevant. And we do think, and Chris likes to talk a lot about, I referenced the last point, the 1984 film Terminator about, I jokingly call him Sarah Connor sometimes, about beating the machine. So I think that Chris and Najim are highly attuned to, the market dynamics that have been, again, just exacerbated by everything that COVID has brought to the fore. If we jump to page 34 in the presentation, it's a bit of a wonky chart. It's a cross-sectional volatility. It's a 12-month moving average. But simplistically, what we're trying to show here on the left-hand side, you see developed markets, and what you see, the blue line representing style, the orange line representing industry, and the gray line representing country. That there's in developed markets, you tend to see a lot of interplay or movement between these different factors over time. As we described before, in emerging markets, historically, most emerging market equities correlate very highly with the country that they sit in. So it's important that we use that as kind of part of the starting point of the framework when we invest. So if you jump to page 35, talk through on both page 35 and 36, how the process comes together. And, the idea generation piece for the team is predicated on, again, when you talk about this idea of quantamental, we do use a number of customized screening tools. One is the CSFB Hold database. We use the Tupper database from Merrill Lynch and Tom McShane. Might not want to hear about competitors, but there's clearly a lot of good investment tools and platforms out there. The portfolio is really built on the underlying ideas that Chris and Najim generate, but also leverages some 350 names that are owned broadly across the other J.O. Hambro teams, because we have some very good, UK equity teams, European equity teams. We run Japanese equities. We have several emerging market teams. We actually have a new global income team that sits in our New York office. So, we want to be able to run those names through our initial fundamental screening process first and rank them and really focus our time and attention on what we think are the best ideas from a fundamental perspective. But what the portfolio is really trying to do is, and I always say, if we oversimplify it, we're trying to find mispriced growth stocks that are in an uptrend. So we want to understand that it is a good company, and we do that by looking at things like incremental changes in earnings revisions, increasing return on invested capital. More recently, I think that the team has been very cognizant of ESG ratings. We can touch on that later, but we do think that it is a very important investment factor that can lead to some very good investment results, and I think one that is not necessarily recognized broadly across the industry yet. Debt levels are very important to us. We tend to avoid companies with highly levered balance sheets. And then the idea of trending up or down, that is the momentum aspect to the portfolio. So we want to buy stocks that are in a fundamental uptrend. So we look at price momentum. We want to make sure that the stock, has at least 6 months of positive price momentum before we contemplate, buying into that particular position. And then, we want to understand how sustainable these company trends are. So we look at, we do kind of classic DuPont analysis where we look at margins, asset turns. Again, we look at leverage. We want to see decreasing leverage. And then ultimately, is there a catalyst or fundamental that's going to, change or impact the company over time? And it can be company specific, and it could be sector specific, or it could, frankly, it could be country specific or regional specific as well. So I think you look at these next two bullet points. Is it a good stock? Or is it a good or bad stock? Do we like the valuation? Is the share price trending up? Is there a catalyst? And then, more importantly, if you jump ahead to page 36, because this also, I think, distills it just a bit better. We want to understand what the impact both the sector and country have. So we want to look at the underlying all sectors, all countries on a global basis. We want to look at sector fundamentals, valuation, and trends, which also includes things like the regulatory environment, our perception of the competitive and capital market cycle, and more importantly, when we look at a stock, is the share price affected by the sector that it sits in? And the same would hold true for the country analysis, also encompassing both monetary and liquidity conditions. And if you jump to page 37, here you'll see an example, which we've tried to, and we jokingly, for those of you that are old enough, if you remember the old Michael J. Fox movie, it looks like the flux capacitor from Back to the Future. I often date myself with some of my younger colleagues. So what you have here, if you look across the three stocks, it's stock A, stock B, and stock C. In a very dated example, they were three names in the material space. There was Newcrest, Rio Tinto, and Vale. And what the green arrow is telling you is that when we ran through our fundamental screen, all of these companies look good to us based on our fundamental analysis. But the crux of this strategy is that we don't want to just buy something based on company fundamentals, because as we say at the bottom, you got to beware of the good house in a bad neighborhood. So when we look at stock A, and again, this in a very dated example was Newcrest, what we saw is it had very low correlation to both the country, to Australia, and to the sector that it's at in the material space. So to us, that's a real, what we like to call idiosyncratic stock, idiosyncratic growth stock, which means the share price movement can be explained by the company fundamentals, as opposed to Rio Tinto, which was stock B in this example, which had a very high correlation to the sector, to the material space. And at that point in time, based on our top-down work, we did not like the material space, so we wanted to avoid that particular name, despite the fact that it had good underlying fundamentals. And stock C, Vale, was a Brazilian name. We had a very negative view on the country at that point. The stock was very highly correlated to the country, so we want to avoid both Rio and Vale in both of those instances. You can have the flip side of this as well. I mean, as much as you want to find, we run a fairly concentrated portfolio. It's between 30 and 60 names. And as much as you want to, or you think you can find 30 idiosyncratic growth stocks, it's just not a reality in this type of market environment. Most stocks only exhibit any kind of idiosyncratic movement 4 times a year when they report earnings. I mean, but there are enough outliers that we can populate a good percentage of the portfolio. But at some point in time too, we end up buying names that are in sectors or in countries that we like, that are going to benefit from some of the positive sector or country trends. If you go to the following page, it'll give you a quick synopsis of the risk management and implementation, or really the portfolio construction process. And I think again, when you talk to Chris and Najim and you think about how they invest, I mean, as I said at the outset, they tend to be kind of expansive, kind of big thinkers. They're looking at global themes and trends, but they understand that you can't just kind of wax poetic about certain things or make forecasts. I mean, what we want to try and do is deal in probabilities and tilt the portfolio accordingly, and also have a very disciplined portfolio construction process. So a couple of the interesting wrinkles about this approach is that it's an equally weighted portfolio, and what we do is we systematically rebalance the portfolio over time. So by equally weighting the portfolio, what we do is we avoid conviction bias. So we don't know if a name, like, I'm just going to pick 2 names, Adidas is going to be a better performer than IFF, which is international flavors and fragrances in the material space, on a month-to-month basis. So we want to equally weight, because we feel that we have high conviction across all of these names. It also tends to tilt the portfolio a little bit more towards mid-cap and a little more of a growth orientation. But we think that that's a systemic process that's helped us over time. And The portfolio, as we also mentioned, is very benchmark agnostic, so we can be plus or minus 25% versus the EFA benchmark on a sector or regional basis, which means that the strategy can have some EM exposure. It could be as high as 25%. If you look at the full life cycle of the fund, I think it's been as high as 19%, and it's been at 0. I mean, we have a small incremental kind of increasing weighting in some of the semiconductor names in an emerging market construct over the past couple of quarters, but it's still relatively low because we feel like EM hasn't really been a great place to invest, of course, over the last 10 years. We also do not buy stocks in relative downtrends, which we talked about that momentum factor before. So we don't buy, as Chris likes to say, the falling knives. We want to see that positive share price momentum. And then the sell discipline is also very structured. So we quote, weed out the losers, right? So we look at stocks, the weakest positions in the fund on a weekly basis. And if a stock is broken through its 52-week relative low, it comes up for review. And I would say 98, 99% of the time, it's going to come out of the portfolio. What we also do is we trim our winners back after we've seen a period of 20 to 40% outperformance to an equally weighted position. And, we sell our winners completely if we feel the price or valuation is really statistically overstretched. So again, we let our winners run, we bank profits, and we weed out the losers. And I think if you look at some of the statistical measures for this strategy, you'll see that the team has exhibited very high batting average of both buys and sells. But interestingly, the batting average of their sells is actually higher than their buys. So they're really good sellers of stocks, which I think, people kind of lose sight of when they're looking at active managers. So I'm going to stop for a second because that's a bit about the process. I do want to carve out a couple, if you have questions about positioning, what we're thinking about markets, because I do think there's a couple of interesting points that I want to refer to in this presentation deck, but I'll take a breather for a second if you guys have questions.
Yeah, any questions on this?
Yeah, it's David. You guys in the last from police, your outperformance is amazing. You're the best relative performing fund we have right now. So thank you very much. What accounts for? You got year to date you're up 15% versus 15 points over the benchmark. That's. Can you tell us what happened? It's what caused that? That's an enormous outperformance.
Yeah. And let me piggyback on that because I'm looking at earlier in your deck around page 8. There's a lot of stuff written, I would say, mid-March.
Yep.
When things weren't looking too good, and now we're mid-July, and there's been this turnaround. So, how has what was written for mid-March? How have you pivoted to get to where you are now?
So, I would say that you're seeing some new since March. There's been some new names coming into the portfolio. The interesting thing about the coronavirus COVID period, as my British peers like to say quite often, is it just exacerbated all the trends that we've seen over the last 10 years, right? So, you look at all of and I think that, let me just take a step back. You have never before in human history had a period where governments have told people to stay home globally, right? So you have a government-induced recession, but you've also had a corresponding both monetary and fiscal response that's unprecedented. The Fed balance sheet basically doubled in the span of 6 to 8 weeks, right? And you've layered on significant fiscal stimulus, not only in the U.S., but, and I think this is something that people haven't really focused on, but also internationally. What's happening in the European Union now, the irony is with Brexit, that the Brits leaving kind of opens the door for, some people have described it, a Hamiltonian moment for the EU and allowing them to have a truly unified fiscal and monetary union, which they're going to issue debt to help, the French, the Dutch, and the Germans kind of finally broke down and are going to help out the peripherals, specifically the Italians and the Spanish and the Greeks, right? So I think that, there's some significant things happening here. But what it's meant from an investing perspective, and most importantly for us, is we haven't really, through the depths of the crisis, we did very little, if anything at all. And Chris, he was a big kind of mountaineering, skiing type guy, says, listen, you can't ski in an avalanche. So when the disaster's happening, you kind of just have to let it happen and then assess where you're going to go from that point forward. I think we were comfortable in terms of our positioning going into the crisis, because if you look at our performance in 18, 19, I think, we did well, but there were some periods when we trailed a bit because we were more conservatively positioned. We had some higher cash levels, but we were also, felt like that, you're kind of getting into this late cycle type environment. Debt issuance had been pretty significant. So we made a very concerted effort. We talked about the fundamental piece to avoid companies with high levels of leverage. And if you look and kind of compare and contrast what we've done, and even some of our other growth-leaning peers, relative to some of your traditional value managers, unfortunately, a lot of those traditional value strategies, irrespective of whether it's U.S. or international, were oriented towards a lot of cyclical, highly levered businesses. And that's clearly not the place you wanted to be in the depths of the COVID crisis. And everyone, I found your opening comments interesting that, the state of Illinois has had to amend public, legislation to allow for these types of meetings. So, and everyone is participating in sessions like this now. So it's just oriented all this capital towards the businesses, these kind of long duration growth stories, that was the trend for the last 10 years. Because in this flat yield curve environment, when your cost of capital is zero, people are willing to put, insane multiples. We'll put Tesla to the side because I feel like that's untethered from reality. But even look at the share price of Microsoft. These growth businesses have done exceptionally well. And I think, what we're fixated on right now, and I just want to take you to one page because I think, let me just see where it is in the deck that you guys have. Because we did have the Q2, we just couldn't get it to you soon enough to get it into the today's conversation. I just want to find. There's a slide, and we referenced this idea of probabilities. Sorry, bear with me. So, if in your presentation deck, go to page 21 if you could. And we always simplistically say the market can only do three things, right? The market goes up with the same leadership, or it goes up with new leadership, which is your scenario 2, you see on page 21, or you have or the market stops, which could be a bull market correction or it could be a bear market. And, what has really driven our performance is the same leadership, technology, growth, companies that have, and the U.S. You see it in U.S. equity prices. You've seen some bouts where, September, October, when you had a spike in the yield curve and people started to shift more towards value and cyclically oriented names. We do think that that's something that we like to say we're kind of eyes wide open for. That is, you've kind of passed this peak. I know that we're kind of rolling back a little bit in terms of state closures, but you've passed this kind of peak work from home scenario. So you could see the market orient itself towards that scenario 2, towards those cyclical value type names, particularly if the reopening goes well. I think the big thing for us, and then I'll stop. The big commentary that I would say is that never in Chris has said this, never in his 30+ year investing career has he seen a market environment where the range of potential outcomes is so wide, and it's because of what I described before, this government-induced shutdown of the entire globe, and then this corresponding fiscal and monetary response, which has just driven capital into all these kind of growth momentum trades. And that could persist, and you could see a huge equity market melt up. But the question is going to become: have we done enough from a monetary and fiscal perspective? And if we haven't, you could see a very severe bear market as well. So when you look at our portfolio positioning, and there's another slide where we discuss probabilities, but I'll give you the more kind of updated probability score around those three scenarios because I do think that is important. But we still maintain a fairly high probability, about 50%, that the market will continue to orient around this scenario 1, which is this flat yield curve growth, quality, momentum type trade. The probability that you get a return to cyclicals has increased from about 10% to 20%, so that number keeps creeping up a bit. But yet, the remaining probability, which is still fairly large, is around this bear market environment. So even if you were to look at the construct of the portfolio, you will see names in there. I would just reference Japan. Like you might have questions about the portfolio slide on page, I believe it's on your slide, page 11. People often ask us, they're like, well, what do you like so much about Japan?
Hey, Damon.
Yes, sorry. Yeah, sorry.
Chris, does that answer your question?
Sorry, I got on a roll. I apologize.
Yeah. Yes. Okay. No. Yeah, you're fine. Yeah. Yep.
Let me stop. Are there other questions?
While we're at it, I've got one note here. Does the U.S. election play any role in what you're doing?
I wouldn't want to say it doesn't. I think that it will be important. It may be more important for the U.S. and our U.S. equity peers. I would be, I think that it might start to shift some people's focus up to areas outside of the U.S. I mean, the only thing is if you get a regime where, a shift in terms of tax regime that starts to impair corporate profitability, I mean, that could, provide some additional headwind because you're already in an earnings downgrade cycle. You have been even going prior to COVID. Our question is just the depth of that, and you see it on page 13 in the presentation.
What about China, Hong Kong, and how does that play into your portfolio?
So I think what you're going to see is, you've already started Cold War 2.0. I mean, you've seen what's gone on in the last 24 hours in the Chinese consulate in Houston. And I think irrespective of who takes the Oval Office, I mean, that aggressive posture towards China is not going to change. And I think it may even actually increase. And I think what's going to happen is, you're going to have to choose sides, right? I mean, there are going to be some countries that can play like the Swiss model and can be neutral and, can sit in between China and the U.S. But I think for a lot of countries, you're going to have to decide, who you want to align yourself with. I mean, the Australians, for example, have issued just a revised defense white paper, and they just issued one 2 years ago. And I think, they themselves understand they need to take a much more aggressive stance towards China in a geopolitical construct. So what I think COVID has also exacerbated is that, a year ago, CEOs were saying, yeah, we need to think about shifting our supply chain and moving away from China. So this idea of China plus one is just going to increase significantly. So people are going to look to move, whether it's onshoring. The Japanese government just came out and they're paying incentives to corporations to either move back to Japan or to move production facilities out of China to other countries in Southeast Asia. So I think that trend's just going to continue. I want to be cognizant of time. Other questions, other things I could address?
Jeff, do you have anything?
Yeah, I guess the only follow-up question I would have is when you guys are looking at themes,
Yep.
How do you balance valuation? Because obviously some of these themes can create extreme valuations.
Correct. I think that part of that is just the discipline underlying the process. We're always paring back our winners and kind of, and banking some of those profits. It is because of the momentum aspect in the portfolio. I mean, we tend to let our winners run, but we're always just incrementally moving them back a bit. Valuation tends to be much more important kind of at point of purchase and understanding, kind of broad equity and sector valuations as well. Country and sector valuations as well. But there isn't as much of a valuation focus as there would be for, say, for example, one of our international peers who just happens to sit in Chicago, like a David Harrow at Harris Associates with Oakmark. I mean, they have, clearly a more dyed-in-the-wool kind of value approach. But that's why we think about the portfolio in a probability construct, because this idea that this tech growth momentum trade is going to persist forever, it's not reality. I mean, it is the trade. It is where the portfolio is tilted a bit more right now. But again, we're looking out to see what is changing. What's going to are we going to have to become much more defensively positioned? I think that is a bigger concern for us, that if the reopening of economies does not go well, that some of these themes and trends look clearly very statistically stretched.
Okay, thanks.
Damon,
Yes.
You have a wrap up?
So I would just say in conclusion, I mean, I think that for us, I think that U.S. investors have clearly, and you probably see it in your own asset allocation discussions. I mean, this idea of diversification and why do I have money in international markets? We do think that our approach in trying to find these idiosyncratic growth stocks, and you see this in some of our Japanese holdings, which are names you probably never heard of, like SBI Holdings, Rakuten, Cyber Agent, Recruit, which actually owns Indeed and Glassdoor, two US recruiting firms. So we think that there's lots of opportunity to find names like that. And I would just reference again what's happening in Europe, because I do think that there's a significant sea change happening. And, you know, U.S. investors really need to watch that space going forward.
All right. Well, thank you very much, Tom and Damon. Anything else, anyone? If not, we will bid you adieu and thank you for your good work. Please
Thank
keep
you for
it
your
up.
visits. We appreciate it.
Thank you.
Bye-bye.
Okay, Melinda, while you have that, why don't we head back to section 7 of our agenda, approval of disbursements.
Yes. So I don't have that up on the screen, so I just have the agenda up here, but Chris is talking about getting us back to item number 7. If anyone needs me to pull up that page, let me know. But what you're going to see is that we had payments for first quarter consulting as well as management fees. We had the payments for our actuarial services as well as the audit services costs to Lauterbach and Amen. There was the Department of Insurance payments and some small legal fees that needed to be paid as well for both of the funds. Does anyone have any questions?
Okay, it's 14 and 15 in your packet. Is there a motion to approve on the fire side?
So moved. It's Mark.
Is there a second?
I will second.
Okay, it's been moved and seconded. Please call the roll.
Mr. Canning? Mr. Canning?
Aye. Oh, sorry. Aye.
Ms. Malloy?
Aye.
Mr. Mitchell?
Aye.
Mr. Weglars? Aye.
Over to police.
Okay, can we get a motion to approve the police pension disbursements as on page 15?
Motion.
A second, please.
I'll second.
Okay, Pat, please call the roll.
Mr. Farina,
Aye.
Mr. Kinzel,
Aye.
Mr. Collins, aye. Mr. Sokolnik,
Aye.
Mr. Paulson.
Aye.
Okay, moving on to the summary of the cash bank account activity. Melinda?
So at this portion of the meeting, it is when I tell you about what is the balance that we have at North Shore Community Bank. We've talked in our previous meetings about the balances that we had at the beginning of the year and how we got to that place. What you're seeing then throughout the course of the year down through June is the ins and outs. So you have employee contributions, there's some property tax collections going in, there's our pension payrolls that are going out. So in the end, we are left with a balance in the fire fund of about 1.9 and about 1.5 in police. These numbers then are carried over into the next slide in your packet, which is a cash flow projection that I have put together. So we have done this over the last several years so that we understand when we might need to make some movements from our investment earnings so that we are able to make our pension payments. And what you're seeing between now and the end of the year, it doesn't look like we're going to need to make any additional moves or changes to bring monies into the funds. In this cash flow, it is contemplating that the next property tax distribution is going to be about 40% of what we would normally expect. That is tied to the county's decision to delay not when property tax bills are due, but when the actual fees for being late on paying your bills. Yes, so that is delayed until October 1st. So what we've done is projected that we're going to get 40% of the collections by August and the remaining 60% in October. Are there any questions?
All right, so that's better news than there was.
Absolutely.
Okay, and then if there's no questions, last under this item is notification of filing of annual statements, Illinois Department of Insurance, which I believe has been done, correct?
That is correct. So the filings have happened, and then right after we got this packet out the door, we got the official notification from the Department of Insurance, and I'll have that in our next meeting packet so that we have it officially in there. But both of the filings have been accepted. So we are completely done with the annual filing to the Department of Insurance.
Okay, any questions from Melinda on that one? Okay, if not, then let's move on to Tom, presentation of second quarter investment results.
Okay.
Tom,
Alrighty.
would you like me to pull up your presentation?
Yes, yes, please, the shortened version.
Yep.
And we'll start with the summary of recent actions, and then I think it's the next page. There you go. So this is just an update of actions that have been taken by the board. In May, we had entered some good to cancel orders based upon certain levels of the S&P 500. That was in May 7th, and then we had additional orders entered in May. It was May 20, the May 21st meeting to purchase $100,000 if the S&P was hit 2,700, and to purchase $100,000 of the Vanguard S&P 500 index fund if it hit 2,800. Just as a point of reference, from the May 7th meeting, we had suspended the dollar cost averaging program once it hit 29.50. And just as a recap on that, on March 31st, the board directed us to purchase $750,000 of the S&P 500 index, and that was when the S&P index was at 2620. And then they also directed we had went and purchased $25,000 a day, and that until it hit 29.50, and that lasted till May 19th. And so altogether, this most recently in the actions that the board took during the coronavirus and the volatility of the market, you invested $1.3 million in the S&P 500. The current value of that investment is $1,595,000, which equates to about a 23% return on the investments that you made and the actions you took. So kudos to the trustees for being not aggressive, but being assertive in adding more to the portfolio. Any questions on that? Okay. So if you go to the next page and looking at that chart of the S&P 500. Okay. So So again, we've rehashed what's occurred, and everybody has been aware of what's happened. The right side of this chart shows the S&P 500 and the levels of the S&P 500, and then the bottom shows the time frame. And so you began your purchase program around 2,600, and you can see that after that purchase market went down, you were buying on a daily basis 25,000, and up until probably, as I said, May 19th, and the market just has done a moonshot to as high as 3,200. So, and we'll talk a little bit, the whys or whats, but if you can go to the next page, please. Excuse me. Sorry.
Bless you.
Thank you. This is a update of the asset class performance through June, and you can see that looking at on a year-to-date basis, the equities, global equities, total of all stocks throughout the world down 6%, U.S. stocks down 3%, international down 10.8%, emerging markets down 9.7%. And on a trending basis, if you go all the way to the right, the 5-year return for global stocks is 6.9. That was held up by the U.S. equities, which is up 10.6 for the last 5 years. But international and emerging market were a drag on the returns, and this is this idea of diversification, and it has into internationals, and it hasn't really helped as far as the overall return for any pension portfolio. Bonds year to date, 6.1 saving grace, and then all at the bottom of this page, or this right before the bottom, cash was 0.5% year to date. The last 12 months, cash was 1.6, and so not much return from cash, but it was positive, and so it was a safe haven. We don't think necessarily that's the case here now, but those are the returns, and and through, just as a point of reference, since June 30th through today in July, the S&P's up another 4.7%. Yikes! So if you go to the next page, please. And this is the Global Investment Committee Weekly. We are sending this out to our trustees on a weekly basis, and this is from, I believe, the July 17th meeting. And if you go to the second page, please, and the bottom line with that dark blue is, and basically we've gone through a full bear market and a full bull market, and we were about 41% from the low on the market. We think, and our firm, which issues this report, the Global Investment Committee, thinks that the economy is on the road to recovery, whether it's durable and whether it's and what other risks that are there. There's many, but we think the market is not cheap. We think it's fairly valued. On average, it's fairly valued, but certain pockets are extended, and we'll look at that in a second. Like technology. And not all sectors have participated in this market, not just value stocks, but just different sectors. This crisis has brought unprecedented government stimulus. We would have never seen this stimulus. Someone's got their mic open. We would have never seen this stimulus if it was a bank crisis, or this is a man-made crisis, and this the government has stepped up significantly in reference to liquidity and keeping rates low. This is a man-made recession. So again, looking at this economy, the idea that we're going to have another lockdown, I don't think we can afford to. And I think that not about profits versus life, but the idea that social distancing, masks, washing hands does a significant prevention to transmitting the disease. But there's a lot of statistics put out there. But we had 2 weeks ago, we had a chart in our Global Investment Committee Weekly that it looked at the different age groups of who accounted for contacting the disease and who had died as a result of it. And 20% of people who were the age of 65 and older accounted for 20% of the cases of the COVID-19, but 78% of the deaths. And that means, on the flip side, the people under 65 account for 80% of the cases, but only 22% of the deaths. Which the idea that younger people can get it, they're just not dying from it, and the reporting of that is more significant now. But the idea that I'm over 65, and it's that's where most of the real crisis and deaths come from, and we don't think that there'll be a lockdown. Psychologically, it would be great if the schools opened. But you don't open it for just to be optimistic. You want to open it for people's safe, but it'd be nice to see that happen. I think, as I understand it, Notre Dame University will have in-line class, person classes. They'll start 2 weeks early, and they'll end in Thanksgiving. At least for now, that's the plan. and so the kids don't go home and come back with with the COVID-19, and but there are risks that are here, and the risk of one is the valuations. If we could go to page 4, I think. Skip. And if you could go down a little bit, so at the bottom right, the risk here is this unemployment that we're coming from a very high number of unemployment, and we're looking at the next I think next week this is the last week for unemployment benefits, and then depending upon certain states how much you get, you don't get. But the point is that there's rising permanent job losses. Will pose a risk to the recovery, and but generally speaking, our economy runs on about 75% of consumer spending, and the monies that were $4.5 trillion put out to individuals mostly. I mean, it got into the pockets of the public, and it's going to restaurants isn't an attractive invitation, but boats, cars, sailboats, motorboats, bicycles, home goods, houses, that business is booming, and so the economy will recover, but it will recover in different sectors. If you could go to the next page, I believe. And one more page, please. At the top of the page is the S&P earnings estimates and our outlook, but I wanted to look more at the S&P 500 sector performance right in the middle of the page. And on a year-to-date basis, there are only 3 sectors that are positive as far as returns are concerned. That would be consumer discretion, up 14% year-to-date, information technology, up 18% year-to-date, and telecommunication services, which includes Google, is up 6.8%. That means the stocks in the S&P is negative for the year slightly, energy is negative, materials, industrials, consumer staples, healthcare, financials, utilities, and real estate are all negative returns for the year. And so that's where the idea of the market at these levels, going back to the idea of that we have orders in below the market, which I think is a good spot to be, because there's there's a fairly valued market, but it isn't widely they don't have a wide participants there, and it's you think you need a little more strength from different industries to, I think, sustain this rally here. So if you look at if you go to the top of the page, please, if you scroll down. So this is this is our firm putting out earnings estimates, and Wall Street putting out various consensus earnings estimates on the left side. Point in reference, though, there's 500 companies in the S&P 500. I believe about 187 have stopped guidance of what they think earnings are going to be. So, these earnings estimates, good luck, but, like anything else, you go on some type of level. And so last year, I think we came in at about 166 in earnings. That's 2019 for the S&P, looking at $130 for the S&P 500 this year, and then increases to 158 next year and 177 in 2022. The right side of the page provides a bear case outlook, 20% probability that earnings will only be $143 a share, and that people would be willing to pay $19 for a buck in earnings, or a target of $2,900, which would be about a 9-10% drop from here. And on the total flip side, bullish case, the market has a greater V, a bigger V, and earnings of 166 for 2021. These are targets for June of 21, by the way. PE ratios expected to be about 21 times earnings, or a target of 3,700, or 16% on the upside, and But generally, where we're at in earnings and valuations, we look for about another 5% on the upside here. We've had bigger charts of this particular estimate and outlook, and if we looked at this a year ago, our expected PE ratio for the S&P 500 was closer to 16 or 17 times earnings. Our analysts, our group thinks that with interest rates that have just been smacked down, with low interest rates, there's higher valuations that you'd be on earnings. There's a higher value of earnings based upon lower interest rates. But point of reference, price earnings ratio is what people are willing to pay, and they're whether they're fearful or aggressive. And so this could change. I think the high multiple we've had was 28 times earnings back in 2002. That's when on the tech stocks, the highly speculative tech stocks. But this is more on providing high earning PE ratio on companies based upon earnings, filling up that and the expectations for earnings. So that's our outlook in reference to the marketplace. Any questions on that, or? Okay, so I think if you go to the next page, please. And we're here. The following pages will have the fire, pension fund, and the police. We'll be looking at the fire for sake of not moving around too much. But so this first page is the current allocation of the portfolio, and we are 35% fixed or target for fixed, and 65% target for equity. We're currently based upon the assets that we manage, we're at 32% fixed income and 67%, almost 68% equity. But if we include North Shore, and I don't have it in front of me because I've got different screens up, but Melinda, who is a tech guru, and she is a tech specialist, she's got it right here. So with the North Shore, currently we're at 65.9% equity for the fire and 65.9% equity for the police, which would suggest that we're over allocated, but based upon appreciation, we don't have to do anything at this level here unless the board thinks they want to pull back in reference to where they're at. So, and I guess that this would be maybe appropriate time to talk about the orders we have in and where we want to be as far as going forward. So maybe we could open that up and maybe just talk about that.
All right. Anyone on fire want to start the conversation? If not, please.
I mean, it's David. I mean, the only thing I was looking at, our large cap stock allocation, which obviously has been a mistake to sell any of it. Maybe we trim back a little bit and maybe throw it back in the bonds where we took the money out before, and just feels like pricey market, and maybe bring it a little bit back into balance. I mean, almost in reverse of what we did 2.5 months ago. I think it's worth discussing, although I have a sneaky suspicion that this market doesn't want to go down because of so much liquidity.
Yeah.
And I'm just looking at a lot of money in cash.
Yeah. I mean, I almost feel like we could give a little to Weaver or somebody who's performed well on the bond side, but I mean, it's kind of tweaking around the edges. I don't know on the police side if anybody has any thoughts, but and I'm also fine leaving it alone, to be honest.
So remember, we're gonna meet again in October. Just keep that in mind.
It seems like a long way away.
Yeah, it does.
So part of that cash you have about, so we're showing the, cash, you have about $500,000 at Vanguard that's earmarked for purchases if the market pulls back. There's, 4 buy orders we have that would utilize that cash and have it available. You're getting about 16 basis points on that, and which
and that's if those orders below the market were to be executed. And then you have the money, of course, at North Shore, which will, you get for pension payouts. So.
Okay, so Tom, the question really becomes, if we're thinking that the market is going to continue to go up, and I'm sure this is, and David, Farina, I don't mean to put words in your mouth, but if we think the market is going to either stay where it's at or go up, then why have the cash sitting here?
Well, my feeling is that whether you want to put it with fixed income, we're not. Well, here's the thing. I don't think cash is the place to be, and if I look at the current levels of the equity market, I would say that we've recovered significantly, and we are at fair value, and that I think that trying to be opportunistic on the downside would be a more viable way to go. And if you want to take some of this cash and put it with fixed income, what you have there, you still have risk. That this I don't think the risk is near term, but there is a risk of inflation rearing its ugly head, and so there'll have to be a decision with that. But certainly, bonds can go down. If you get a move in rates upward, which I don't really see happening. So,
no.
But I don't think I don't feel like that I would. Well, first of all, not doing anything would be suggest that you're bullish on the market, because that would you're staying above 65%. Fixed income, it's, I mean, what are we getting at North Shore as far as yield? I mean, not probably 15 basis points or something?
It's going to, so we get,
I thought it was more like 25.
Yeah, it probably is sitting about there right now. We get, I want to say it's 20 or 25 basis points over the T-bill.
Okay. That's about 25 basis points.
Yeah.
So, yeah.
Right.
Yeah. So I feel we're in good shape. I think that if I was to do anything, I would put money with Weaver. And Weaver's 60% corporate bonds, so they have a little bit more juice in there, and they've been nimble enough to move around in that arena.
And looking at the numbers, like Dave, I'm fine with not doing anything, but if we're going to tweak this, Weaver seems to have performed quite well this year. So, I mean, moving something to them makes a lot of sense.
Does anyone want to propose a dollar amount?
Jeff, on anybody on the police side, I mean, we're about, according to the allocation, about $1 million over on equities. I mean, well, then when we look at the cash, I don't really count at North Shore. We're only, $500,000 over. I mean, I'd be okay moving $500,000 to Weaver or something like that. But Jeff, love to hear your view.
Yeah, I think that makes sense, because the market has come a long way, and right now, to me, it's a binary scenario with mainly downside risk, because if in September we get an announcement on the vaccine that's positive, hopefully, the market might pop a little bit, but I think the market is mainly discounting that scenario. So conversely, if, God forbid, there's bad news on vaccines, there's significant downside. So now that said, the base case is that at least one of these vaccines will work, so I'm not suggesting that we take a huge move, but some move makes sense to me. The only risk on the Weaver side is And I think the Fed's on hold for a while, so I think we're fine. The longer, if we do get a vaccine announcement, at some point, probably the 10-year bond could move up pretty significantly. I mean, theoretically we could see the 10-year. I mean, there were people forecasting the 10-year goes to 100, 125 basis points by the end of the year. So that's also going to be a function of the vaccine and people's outlook for the economy. So that's our only risk, is that we get a backup in interest rates. But presumably Weaver will put them in fairly short-term corporate bonds.
I don't think fairly. There'll be more. Probably the intermediate gov credit, which has got a duration of about 5. They might be about, go to 4.5. They'll still have exposure, interest rate exposure risk. And
okay. They don't have any short-term bonds.
Well, they do, but I mean, it's not. I think that their assignment is their assignment is a duration that's closer to the intermediate gov credit than it is.
Okay.
It's not. They're not. Where the shorter term is what you call it. SKBA has that portfolio that he's pretty much kept it, 9 months or so, and it's with the corporate bonds you do have there's a greater coupon, which does provide for convexity and some protection of the portfolio as far as if rates do rise. Buying premium bonds can provide for some protection on upward swing in rates, and the risk. There's a building risk of inflation based upon the vast amount of money that's been put out into the economy, along with the fact that you have certain demographics changing. 10 years ago, people who were 60 were staying on the job and continuing to work, and they didn't have any wage demands. Today, you've got an older workforce, you've got younger workforce coming in, higher demand on wages. There's also this supply chain issue where bringing production closer to home, in the U.S. or Canada or Mexico, which will be more costly ultimately. And but if I could get a testing or material in 2 weeks instead of 3 months, we'll pay more. But those are along with the fact, the amount of money out there, demographics, the idea of inflation is definitely that something that would be a surprise and a negative. And the Fed has indicated that they're willing to let inflation run. And the concern is once you let inflation run, can you reel it back in? But no one's going to knock on my door and say, "Hey, inflation is going to rear its ugly head, and you better get out of bonds." It's it's not. It's so corporate bonds. I would go if we were to put money in the fixed income. I would put it in with Weaver. Not so much that they've done well, but because they have a higher percentage in corporate bonds, which I think is not it's more of a proxy for equities. It's if we're moving up in a V-shaped economy, corporate bonds should do fairly well, minus a bump in interest rates.
Yeah, I was going to say if we get a vaccine and the Treasury bonds are backing up, then presumably corporate spreads will come in a little bit as an offset.
Yeah.
I don't think there's huge risk, especially over between now and the end of the year.
Jason or Mark, any comments?
No, I'm fine with either taking some out of cash or leaving it as it is. I'm good either way. I'm comfortable.
Mark or Linda?
Yeah, and I'm going to throw this out there. I apologize, Mark. Let's think about it this way, and maybe it would be helpful if I went back to that slide. Is there a certain amount of money that we would like to leave in cash just in case there is a movement that we need to do something again? So what I'm trying to do is go back to the parameters that we set before to help us kind of think about what would be a dollar amount that we would be comfortable moving. So in saying that, is it that we want to take about 300,000 of this and then leave the rest? Or do we want to leave 300,000 in here to facilitate one of the movements that we've talked about before in the past? Does that make sense?
Well, Dave Farina, wasn't your thought to pull it out of large cap?
Yeah, I mean, I'm looking at this. If we hit these levels, I mean, I'm just looking at my screen right now. S&P closed, 32 something, 32.56. We're a ways away. So that if we hit those levels, we've lost 10% already, if not more. So I mean, I think that would imply you take it out of the S&P, you leave the cash alone, you move it to Weaver, and if we hit these levels, we're buying back. So I would take maybe $500,000. Is kind of my thinking out of S&P. I go even as high as $1 million. We balance ourselves, and then we leave the cash there just in case we go through another dip.
Yeah.
Anybody else? Please?
Yeah, that makes sense. Makes sense to me.
To rebalance, it's going to be less than 500,000. When we looked at the page that Tom had put together from the presentation, it didn't have the North Shore cash as part of it. So the differences would be, just to round the numbers, on police, it's about, let's just say 475,000, and for fire, it's about 460,000 to rebalance the portfolios.
So what?
Right, and the S&P was down 1.23% today.
Yeah. So why don't we do this, if it makes sense for play? Why don't we take $500,000 out, nice round number. It'll take us down to, 64 and change, 64.8. That's a lot of exposure, given how high the market is. We still have our cash to buy, and we move it to Weaver. And maybe if the market goes up, we didn't, we only moved $500,000. If it went down, we protected ourselves. So I don't know. That seems like it makes sense to me, but I'm loving another thought.
Yep, makes sense to me.
I concur. On the fire side.
I would concur on the fire side as well.
All right, Mark, you want to make a motion to that effect?
Yes. Wording.
Well, the idea is to move 500 out of
500 out of.
Hold on. Let me get this in front of me. Out of Vanguard, probably.
Yeah. Yes. The Vanguard.
Makes sense, Jason.
Okay.
Yeah, 500 out of Vanguard S&P.
Yeah.
Into Weaver.
Into Weaver.
500K from Vanguard SP to Weaver. All right.
Is that your Mark?
Yes.
Jason, you second?
I will second the motion.
Discussion? Linda, anything to add?
No, I think we're good. We just need to take our roll call vote.
Yep. Jason, please call the roll.
Mr. Canning?
Aye.
Ms. Malloy?
Aye.
Mr. Mitchell?
Aye.
Mr. Weglars? Aye.
Okay, please.
Are you guys all, Pat, you guys okay with this?
Yes, I'm comfortable with it.
Okay.
Yes, I'm good. So Marty.
All right. So I'll make a motion to move 500,000 out of the Vanguard S&P fund and to Weaver. We get a second?
Second.
Second.
Okay, roll call, Pat.
Kolnick is second. Roll call vote. Mr. Farina?
Aye.
Mr. Kinzel?
Aye.
Mr. Collins? Aye. Mr. Sokolnik?
Aye.
Mr. Paulson?
Aye.
Motion carries.
Okay, I think that concludes asset allocation review and possible portfolio rebalance. Tom, anything else?
Just, just to kind of review, if you go to the next page, please, page 2. And so this is, I'll go back one page, please. Just to review where your money's at. And in the large cap equity, you utilize the Vanguard index fund. And then the mid cap, you use 2 separate mutual funds, the Vanguard Mid Cap ETF, and then Columbia Acorn Fund. Small cap equity is London separately managed account, and then this is for the fire. You have the exchange traded small cap fund. Real estate fund, Vanguard International. You use American funds, international equity. You use the index fund, MSCI, Tweedy Brown Global Value, Joachim International, and emerging markets, American New World and Lazard. And then in the fixed income, you have Spare Kaplan, which is the Max Flex, which is the goal of that is to go anywhere, go long term, go short term as far as positioning a portfolio. And then the Flex Fixed is corporate bonds and treasuries on the intermediate gov credit. And a Weaver is assigned to have a portfolio of at least 60% corporates and the rest treasuries. And then you have the money market fund at Vanguard, and then the self-managed, which is a self-emptying Ginnie Mae portfolio. There's about 8,000 left in it, I think. So any questions on that, or so if you could go 2 pages further, we'd look at the one more page. There you go. Okay, so the fund itself on a year-to-date basis is down 2.84%. On a quarter-to-date basis, up 14.34% versus the benchmark of 14.2. And in 1 year, you're at 3.41% for the portfolio. Looking at a year-to-date basis, the down 2.5, and for the S&P 500, the mid cap 12.8% down on a year-to-date basis, but for the quarter up 24%, and Acorn for the year-to-date up 1% versus the benchmark 2, indicative of mid and conservative has been less of a participant in the upside. London, we keep waiting for them to show their colors as far as return is concerned, down 16 versus down 13 for the benchmark, and they've averaged since inception 6.8% versus 8.1. Looking at American funds, Euro Pacific, that has been helpful for the portfolio. Year to date, down 4.7 versus 11%, and on a 1 year basis, up 3 versus negative 4.8 for the index fund. And if you could scroll the page up a little bit, I can't see everything, Melinda. Okay, thank you. So, Joachim was up 7.8% for the last 12 months, and year to date 4.37%. And since you hired them, up 11 versus 1.8. God love them, that's great. And then Tweedy Brown, which is a more conservative, value-orientated, has had a little bit more difficult time, and was down 11 for the last 12 months versus the benchmark 5%, and they're negative 3.4 versus that's from December of 2018, and versus 1.4 for the benchmark, 1.84. American New World has protected the portfolio somewhat, both on a year-to-date basis, 12 months and since inception. Lazard, about time to get rid of them, and down 21 year-to-date versus 9 and 15% for the last 12 months versus 3.3. Could go to the next page, please. And this is your fixed income managers over the last 12 months. The
Weaver is has been a good earner. They up 10 versus 7.23. The Spare Kaplan year to date, 1 year is up 9% versus 10, and then the Max Flex up 5.73 versus 4.12. And so that's the performance of the various managers. If you could move forward a little bit to, I think it's like say page 9, looking at the long-term risk return of the portfolio. If you could keep going, please. Keep going, please. Keep going. One more page, I think. So this is the fund, looking at it since 2003, since inception. You're running a net return after cost and everything of 6 versus the benchmark 6.52. You've had beginning balance, looking at the middle of the page, $20,281,000. Net contributions out the door for pension benefits, $8.1 million. Fees and expenses, $755,000. You have income from dividends and interest of $16.8 million, and the gains and losses of either realized or unrealized of $19.3 million. Ending value of $47,655,000. So that's. Any questions on that or discussion?
Anyone?
You know what, Tom, I'm just going to ask you, you made a comment when you were reviewing, I guess we can look at them here. Wasn't it?
It was Lazard.
Lazard. Do you think we need to start, here we go. Do we need to start talking about doing something with them?
Right. Well, so I think, it's not been an environment for any value type of managers, and so that doesn't mean you have to go down with the ship. There's other value managers that have made certain changes, and but I think Lazard and with the London company, we've given them both enough time to provide for some added return, and so it's either here we fire them and put them into the index fund, though I keep thinking that active manager would be a better in these arenas. So I'm suggesting that we just hold them, but with this idea at the next meeting we do a deep dive on the active managers for the emerging market and for the small cap arena, and either replace them with a different mutual fund or with an index fund. But I think I think the board certainly has given them enough time to. So we can you can dump them right now, put them in an index fund, and we can look at active manager possibility at the next meeting, or wait at the next meeting to look at all of that. But I think I don't have to be a genius to say I think it's not working out.
Well, part of me thinks that we have an annual discussion about Lazard, and I'm wondering if Tom, your point is we've been giving them enough time and nothing's working. What I don't want to go through, and Melinda, I'm trying to think of a quick way to avoid this, is I don't want to come to the October meeting and we have your research, Tom, which lays out a number of different companies to review. I'm almost wondering if we could have a quick subcommittee, have Tom do his research, have the committee look at it and see if they narrow down to some recommendations, so we can short circuit that process. And if we make the change, we're ready to go at the October meeting. So, maybe what we've done in the past is just had a small subcommittee with one person from fire, one from police, and I think Tom, and let them do a vet of the larger group and narrow it down. What do you think?
You are correct, Chris. We've done that in the past, and it's made things more effective, I think, for all of us. It's given us a chance to be a little bit more nimble on things and to actually take action then at the subsequent gathering of the whole board.
You know, with my thought being, Tom, you take a couple weeks, pull together what you think, circulate it to the subcommittee, put together a call, and then our next meeting we'll have a report of the subcommittee with their recommendations, and we'll see what it is in the packet. We'll have a chance to review it, and we can vote and take action at the next meeting.
Sounds like a plan.
Okay. Any volunteers on the fire side for the subcommittee? And Jason, yes, you can volunteer. Dave.
Yeah. You know, Dave told me that he wanted to do it, so if no one else does.
Well, I think Dave, I appreciate Dave's willingness to volunteer. Anybody on police?
I can do it.
Yeah, sure. Okay.
Yep.
All right, so Tom, if you can work with Jeff and Dave, and then we'll facilitate that.
So I will provide data regarding the small cap manager and the emerging market manager mutual fund.
And Tom, I mean, my inclination, you know, emerging markets is one thing. You know, I think you need an active manager. On the small cap side, I might be inclined to go to a Russell index, or I don't know. I mean, it just seems like, you know, we get lucky, we don't get lucky. You know, we're trying to match the benchmark. You know, I keep thinking the lower costs in the indexers have served us really well. You know, on small cap, I love your views. I mean, you can argue that there's you know, probably the one sector where you have the most potential for alpha, but you know, also.
Well, Dave, I think I agree and I understand. What I would say is let the process play, because either the managers show or they don't show, and then you use an index fund. I think at the meeting or with the subcommittee, I think it would be the objective to say, well, who are active replacements, and if they're appropriate, if not, then we go to the index fund, and you know so that's my thought. I mean, you can just go straight to the index and
no, I was saying I thought we were just doing are we doing? Is the subcommittee going to evaluate both the small cap and Lazard's emerging markets, or just the Lazard?
No, I would expect them to do both, and
okay.
Yeah, if you know, I could see, to your point, Dave. You know, and we've all looked at these analysis. Sometimes they just leave you cold, and you know, then it's you know, the mutual fund just makes sense, and we move on. But I think, you know, Tom's flagged this. We've flagged Lazard a number of times over the years. You know, I think let's just run out this ground ball, see where it takes us, and if there's nothing worth going, and we just don't think it makes a lot of sense, then we do have a fallback position.
Okay, fine with me.
But I don't want this to linger past the October meeting.
Okay, sounds good.
Okay. Sounds like a plan.
All right, anything else, Tom?
That's it for me. So let me just clarify a couple of items, if I may. One is that for the October meeting, we'll have a subcommittee for the emerging market mutual fund and the small cap mutual fund. Two is that we're going to take $500,000 from the S&P 500 at Vanguard, and that will be moved in place with Weaver. That money will be liquidated at Vanguard. That has to go. It's set up to go to North Shore, Melinda, and then you'll send it to us. That's kind of how Vanguard's set up for. Just so we can talk about that. And then we're keeping the buy orders in that are below the market at Vanguard, and that money that's there for that purpose. Is that correct?
Yes.
Okay.
Yes.
All right. Good. Then
You got it all.
I've got my marching orders.
Okay. Then that concludes section 8 on our agenda. Moving on to section 9, conference, seminar, training, discussion. Anyone on fire have anything to add? Anything on police?
Pat, did you have something?
For the, we'll have to look at the IPPFA online training, or for this 8 hours. I think all of us, except for Sokolnik, will have to do the 32 hours. So there are some live 32-hour classes. They get to see a 4-hour class for that transition for all of us.
Yeah, that was in Carolyn's materials, and I think she sent out an email about that as well.
Yes, that they have. I think there's that class that's out there. Is that what you're referring to, Pat?
Yes.
Yes. All right. So to the point as this is being brought up, we still are all responsible for making sure that we're getting in the training that's required, so that 4 hours, we all have to get that training.
Right. Okay. I don't think we have semi-annual review of closed executive session minutes. So we'll move on to fire disability matters, Burns annual evaluation. I've asked Carolyn to start that process. Just by way of background, we have to do this on an annual basis. We did it last year a little bit late. COVID hit, and it turns out that Dr. Samo's office was closed until July 1st. So we are moving ahead in a timely fashion. Any police disability matters?
Pat, we have something on the calendar, correct?
Yes, we now have a date of September 1st at 3 p.m. Location to be determined. They're doing in person, so we'll have to figure that out.
And that's a hearing, Pat?
Yes.
Okay.
So tell me again really quick, Pat, what is the date that you guys have right now?
September 1st, Tuesday, September 1st at 3 p.m. I think when we talked about this before, we're thinking the chambers.
Yeah, trying to figure out some way to facilitate that. Yes, we'll
spread it out
for
through there.
discussion. Yep. Okay. Are there any other questions about the disability matters?
That has to be in person?
The
I believe
hearing,
so.
I believe, does, and I think in this material that we have, it's either in this material or one that we received last time. It talks about disability hearings are supposed to be in person, I believe. Pat, is that your understanding?
Yes.
Okay. I guess we'll figure something out.
Here we go. Disability proceedings. I think it's on this page. So anyways, we'll have, so Pat will be reaching out about some additional things, and he and I have been talking about trying to figure out a way to make that happen. So we'll keep working on that.
Okay. Any new, old, or unfinished business? Melinda, do you have anything?
I do. I'm just going to raise two things. Number one is, well, first of all, before I go any further, I made sure I included this item for fire to take a look at and to remember that there's, I think this talks about the some of the training that we mentioned before, and it's giving some sites to look at so that you can keep up to date on where the consolidation work has happened and when there's going to be elections. So that's one item. Secondly, we had discussed this at our last full meeting, that we had received an audit from the Department of Insurance. Both funds did. It's a 10-year audit. We have been gathering information. We have received several extensions, which isn't surprising given the COVID and stay-at-home orders and our inability then to be able to pull material together. We are now making a push to start providing and gathering more data. So Lynn from my staff is working with both Pat and Dave, the secretaries of both the funds, to pull more information together. Just a heads up that there might be occasion that we'll be reaching out to tap into people's memories about where some information might reside. Again, this is a 10-year audit that we are responding to. And one more item, the actuary reports. I had let you know at the last meeting that those were completed. They went to the board approved them. I thought we were going to have them on this agenda. I apologize for the full reports not being a part of our packet. I will make sure that occurs at our next meeting, but do know that those are out on our website. And if anyone has any questions about them, please feel free to reach out.
Okay, Jason or Mark, anything else under new or old or unfinished business?
Chris, does the board have any interest in pursuing any kind of litigation to challenge the consolidation law?
We'll pause that, Mark, and we will pass that to Pat Collins.
Pat, do you want to talk about the letter we got?
So, another trustee from a neighboring police department forwarded a letter from it's attorney.
Conasec
and Dillon, dated June 19th, 2020.
Yes, and he supposedly he was there's some reached out by Article 3 police pension to look into the legality of this consolidation. In the letter, he kind of details it out and basically says his firm has projected a budget of $250K in legal fees. To basically, the goal would be to file a motion for a prelim injunction by mid-August. And so unfortunately, we're kind of on the late side of this. He's wanting to know if a pension board would want to be in this by July 31st. We would not be able to take action on this. I think Chris has a little bit more knowledge on this than me.
So I had seen this topic referenced in Carolyn's quarterly update. I keep trying to move Melinda's screen, but I can't.
But ask and you shall receive.
It's on page 186
right
of your
here.
packet.
Yep, I have it here, Chris.
And it's down to bottom. And when I was getting caught up with Carolyn, she wanted to know if I had received this particular letter. I said no. What I knew about it was what was in her newsletter. So she sent me a copy of the letter. One thing that struck her was the opening line seemed odd, because as her reading is, not only is it on the police side and there's no mention of fire per se, but it seems to be written on behalf of people who are part of the transition board itself, was how she was reading it, and not necessarily a regular Article 3 trustee like Dave or Jeff or Pat. So that in and of itself seemed a little bit odd, because that's almost kind of creating a conflict of interest, and you on the board are trying to have a constitutional challenge to the board you're on. So the second topic was that when I looked into it, I'm not familiar with this law firm and not familiar with why they would be, of an expert nature to bring a constitutional challenge. And then third, it's very clear that they're looking for a financial contribution from anybody who would be part of the plaintiffs. And as I said to Pat Collins, it seemed to me that that was a very large amount of money to use as an opening fund to bring a complaint, which will then have some motion practice, and presumably it will either be granted or denied, and then it will be appealed, and it will go to the Supreme Court, if anywhere. So those were kind of red flags, and And Carolyn and I also talked about the idea that they're trying to get a date for when this is going to be done, and then the next topic they'll probably discuss is where to file this, whether it will be in Cook County, DuPage County, Sangamon County, where Springfield's located, or somewhere else. So there's just a lot of variables in this letter, just kind of showing up without much more is a little hard to react to, but the boards can take a look at it, and if boards want to take action between now and that 31st date, they can probably schedule a meeting to do that. I also don't know that 31st date is hard and fast. I mean, it's having built coalitions in the past and asked for financial contributions. We've been clearly very flexible. If someone wants to join the cause and write a check, that can be done.
So Chris, a couple things. I mean, I think to me there's two issues here. One is this letter from this law firm, which I have no way of knowing anything about them. You don't really know them. There's some red flags. That's the letter. The second issue is the bigger issue in my mind is, as a fund, this has always seemed to me, and I'm not a beneficiary of the fund, but if I were a beneficiary, I'm not sure I would want my money going to the state. I can't see any upside. And again, my view, for the pensioners in Wilmette, I don't see any upside, and they only see downside. And it's not what they're doing today. It's what they may do in 5 or 10 or 15 years that I would worry about. But that's really a decision that the membership has to make, in my mind. It's not like Pat and the guys who are the beneficiaries to me. But, so I think there's two issues here. One, is this something we would want to challenge? And then B, is this something that are these the right guys, the right people? Shut up.
Well, I think the theory has always been with consolidation is that by pooling the assets, you're going to have better returns and less expenses, and both of those will be passed on to the individual funds. So assuming that you're going to have the returns, it's a net positive, and that's why the legislature adopted this. I mean, at a very, very simplistic level.
Chris,
I understand that, but I also would argue that our costs are exceedingly low because none of us are being paid, and we use very low cost funds, and what Tom charges us is de minimis. And so I think our cost is...
What a rate.
Yeah, that's all.
Dave, don't say that when Tom's on the phone.
Yeah, well, you know what I'm saying. I mean, it's not our costs are not high, and the downside, of losing control to me would be bigger than the upside we could get from some foreign, entity controlling Wilmette's money. That's how I look at it. But that's how I look at it.
Mm-hmm. Mark, you had a question.
Does the municipal league have a posture on this?
I haven't reached out to them. I got the information from Carolyn on Monday, and Pat and I talked about it a little bit a couple hours ago.
Okay.
But I mean, that's fairly easy for me to find out.
Okay.
And I do think, again, reading between the lines, I think Carolyn was also surprised that this was a police-driven initiative. And my sense is she's only heard about it on the police side and not the fire side. But again, I don't know if that makes any difference whatsoever, but it was just in so much of what I've done, fire has taken the lead on a lot of issues. So to not, at least from somebody who's practicing in that field, like Carolyn, to not hear from fire she thought a little surprising.
Yeah, I have not heard anything from our lobbyists on anything like this.
And she represents, many fire and police boards, but
correct.
So it was just, it's just a data point and nothing more than that.
Okay.
Do you know if with that they're challenging both the pooling of the funds to the consolidated fund, as well as some of those other points that they changed for tier 2, as far as some of the benefits went, with COLAs and other things that they changed.
In looking at the letter, and I'm skimming the letter right now.
I don't see anything where it mentioned about the tier.
Right, I didn't
say. Yeah, there's no mention of tier 2.
It was all about the transferring the funds, the cost.
Right.
That was going to be basically passed on to the funds.
Okay. Yeah, because there's.
I thought the tier 2 issue had to be addressed by the legislature.
Right.
But that doesn't seem to be a topic. That does not seem to be a topic here because, and Mark, they write specifically, we intend to file a motion for preliminary injunction seeking to have the court enjoin the state from transferring municipal pension funds assets to the funds. They go on to say they'll seek a declaratory judgment action seeking to have the public act deemed unconstitutional and that diminishes the contract entered into by your members, which heretofore relied on local board to manage their pension. Memo to file, if you used heretofore, you can charge more. So to your question about Article 2, the letter is silent on it.
Okay.
So I think, Mark, Pat had a copy of the letter. He received it. I had a copy of the letter. We're bringing it up under new, old, or unfinished business. I don't believe we can take any action on this, but if the board wanted to take action, they'd have to do it at a separate meeting, properly noticed. I do think, Dave Farina's point about getting feedback from the membership, that is kind of interesting because I have no idea what the membership feels about this. And Jason, I know Dave's not there, but I mean, have you heard anything from the membership? And then the same question for you, John and Pat and Marty. Have you heard anything on your side?
I'll start off. So I think there's two parts to it. I think some of the older members don't want this to happen, and I think some of the younger members are okay with it happening because of the increase in benefits that they received being part of the tier 2 that went along with it.
And I'll agree with that sentiment on our side. I think with us being a little more wary of consolidating the funds in general, but then tier 2 being a little more accepting of it for that same reason, because it corrected, or at least it helped a large issue that was kind of brewing otherwise.
Some of the members that I've heard from, the tier 2 stuff, I think there's no objection to that part of it. It's more about what Dave was kind of indicating about what is going to happen down the road. I think one of the funds, Arizona, was consolidated, and then they changed the benefits. They started messing around with the benefits portion. So there's that concern.
I haven't heard from anybody, if you want my input. I did think when Pat sent me this letter, I did have some of the same questions that Chris brought up, and I think it would be interesting to find out what the retired members actually thought.
So this is Melinda. I'm going to say that in this material that you have, and even in this letter that we're looking at right now, there are meetings that are occurring as they are making decisions about the boards. I think if folks are curious and have more questions, I would strongly suggest that people start attending them. I'm going to guess that they are doing them in a similar manner to what we're doing right now. So you could either participate visually, or you'd be able to call in to get some more information about what's going on.
What meetings are those?
Well, the transition board has been meeting for the last couple months.
Yes. Yeah, and I think they're in two different places. I think, I can't remember which has gotten further along, whether police or fire. But
the fire has a website, and the police does not. They have LinkedIn, but the fire is definitely well along in reference to having a website, and then you can get the Zoom meeting. I haven't quite seen the same success with getting on the police meetings.
Yeah, I'm going back. I see Carolyn sent us there was a meeting on March 30th. I don't see. I'm assuming there's one after that, but I can find out from her. That won't be a problem to get that information to see what the dates of the more recent ones are. So I'll just make a note for me to do that.
Pat and the active guys, if I can make a suggestion, why don't you guys, have some conversations amongst your memberships. Figure out, if you guys are okay with this or not. And if you're not, then we should do something. And if you are, then we don't have to do anything. I don't know what the best way to do that or the legal, if we have to do something formal, Melinda, tell me. But, if this is something that you guys feel strongly about that's a bad idea, then, we should talk about it. And if you guys are all okay with it as a group, then so be it.
I will say that if you want to do something formal, whether it's police, fire, or both, and there is an expenditure of funds, that will require a meeting and a vote.
No, I understand, but the question I was asking, Chris, is does the membership care about this issue enough that we, should do something? Right. If the membership doesn't care, then why would if it's not an issue for them? Yeah.
And I think I get what Dave's saying is just that he basically, I could send an email to the beneficiaries or pensioners, and also an email to all the active people saying this letter's out there. Would get your opinions that way. Is that what you're kind of like a poll?
I don't know. What I was thinking, I'm not sure I'd send them the letter. I would just say, there is nearby villages who are contemplating a challenge to this order for this reason. And, they've asked us to look into it. And, is this I don't know. Melinda, you help me out here. I mean, I'm probably way overstepping my grounds here.
Okay. Here's what as you were saying things, David, here was the things that were going through my mind. If it is I think what needs to happen is then the membership needs to be educated about what the consolidation means. Exactly. And so what we have up right now is, the IF organization, whatever, they have some information out there. I think the best thing to do would be to gather that stuff up, because if you remember at one of wasn't our meeting it would have been one of our meetings last year, we had a substantial amount of material in that agenda that was explaining pros and cons to the consolidation and what it was supposed to achieve. So I would suggest, and that's out on the website, I would suggest that people get educated about what the consolidation is attempting to do, and then understand if somehow there is action that folks want to take. But I think they also need to understand then where the process is right now, and folks can get on these boards if they want to, but the window is closing. So I think, again, if we want to have an effect on what's going on, then people should be serious about looking at getting on one of these boards. That would be a way to understand what's happening.
And one other thing I would add, Melinda, I think in our materials or subsequently, I believe we've got a memo from Carolyn, and I believe one from Rick Reamer, a recap of what was passed.
Yes.
So beyond the pros and cons of the debate, there is an actual report with each of their thinkings on what actually got passed and what it will do.
And really, the election process, I think it goes until September, if I remember correctly. So it opened up in July. That again, if there's concerns, the membership should start talking about, do you want to try to get on one of the boards, to be a part of it?
Well, Linda, can I just? I know I have a vested interest in it being involved with the funds. To get on to be elected, you need 400 signatures. That seems to be a little onerous for somebody to get on the board. But if you need to, you better get going now. Is what you're saying, right?
Absolutely. So, Tom, you are right. I am not making any comment on their process, but I'm just saying if folks are serious about it, then they really need to look at what it takes to get on these boards, and it would be a good idea to get on the board. Because then it's the process, I guess, because, Tom, what I'm saying is the process is going along. It's happening. I don't know, David, to be quite honest, if we decided that we weren't happy about this consolidation, that somehow if Wilmette stands up and raises its hand, that it can do anything about it on its own. But there's some channels right now still that exist to be a part of what is happening.
So I think those are all good suggestions. I've reached out to Carolyn to try to find out other dates, which I can get to Melinda and she can send to everybody for an update on the process.
Great.
Any further discussion on this? Okay. Any additional new, old, or unfinished business? Okay, seeing none, is there a motion to adjourn on the fire side?
I would move to adjourn.
Is there a second?
Second.
Okay, roll call, please.
Mr. Canning?
Aye.
Ms. Malloy?
Aye.
Mr. Mitchell?
Aye.
Mr. Weglars? Aye.
Fire stands adjourned.
Please, can we get a motion to adjourn, please?
Motion.
Second, please.
John, I'll second.
At the roll call.
Mr. Frieda?
Aye.
Mr. Kinzel? Mr. Kinzel?
Is he on mute? Did we lose him?
No, he's there. I think he's muted.
Just move on. We have a.
Mr. Collins, aye. Mr. Sokolnik?
Aye.
All right, so
Mr. Paulson?
Aye.
One last chance, Mr. Kinzel.
all right, please stands adjourned.
All right, thanks everybody. It was nice to see all of you.